Hello, everyone. This is Jordan. Welcome back to the Daily Gold YouTube channel, and welcome to this edition of Macro Mondays for Monday, August 4th, 2025. Thank you so much for tuning in. Hope you all had a great weekend. And in today's video, I'm going to get very specific and very technical. I'm going to delve more into gold's current consolidation and discuss how and why gold and other markets, why they can go sideways and consolidate for months and months. And I'm going to go through a handful of charts here, so just bear with me. I'll try and go through it all quickly, but without further ado, let me get to those charts. So this is the present situation for gold. This is the daily candle chart. And we see here what's going on for now 3.5 months. Gold is consolidating. It's clearly in a range from 3450 on the upside to, on the downside, call it 3200 or even 3175. Now, typically, after a market makes a big move, now we have a big move from the breakout, the beautiful cup and handle breakout in March of 2023, breaking above $2,100 and running all the way to 3450. That's a big move, but you know what also is a big move? This is a sharp move. We were down here at the beginning of the year, 2,600, and gold moved up all the way to essentially 3,500. That is a huge move in only 3.5 months. And so this came at the end of that breakout move from the cup and handle. It happens in other markets too, but you see this in gold, and we'll go through the history. After it makes a big impulsive move, it peaks, and then it tends to consolidate. This is what happens in a secular bull market. It peaks, and then it goes sideways, corrects in time for a number of months. And so this is where we are, clearly in a consolidation, a market that is in a sideways range, and that, in my opinion, has more time to go. Because if we look at these moving averages, the 150-day here and the 200-day, the market is too far above these moving averages. It has not come down and gotten close to them yet. And so throughout history, a lot of these consolidations, they will end with a test of the 200-day, or they get really close to it before moving higher. So that's the big picture. Now, a couple of things I want to look at are, with respect to gold's history, the width of the Bollinger Bands. So these are 200-day Bollinger Bands. Now, the middle is the 200-day moving average. Now, the width here just shows the width of these bands. Like we can see here, they're super wide. Now, Bollinger Band width is a volatility indicator. And so a market will make really big moves, big breakout moves, when volatility is at a low point. So we're looking at the 1970s here. And so I marked here when volatility was at a low point. There's numerous examples we can see here. I could have marked this one. Just because volatility is at a low point, that doesn't necessarily mean the market is going to make a huge breakout move higher. But we can see, looking at these points, this was kind of a breakout move here in 79, here in 78, a mini cup and handle, you could say, or a continuation inverse head and shoulders pattern. And clearly we can see here, this is another one, another sharp move here after the correction, which is, I think, the best comparison for where we are here and now. So we see that, but also when Bollinger Bandwidth gets to really high levels, and this is just the width of the 200 days. You can choose longer periods or shorter periods. But we can see here, when this blows out to the upside, a move can be mature, as we see here, 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 and of course, the epic peak there. So this is 2001 to 2011, and we can see here what happens when Bollinger Bandwidth really blows out to the upside. That's another peak here. 2008, that was another peak. Of course, that was a secular peak. This one in 2004. But when it's on the low side, we can see Low side right here, move like that. Low here, didn't do much. Low point here, move like that. Another low point here, big breakout move. Low point here, another big breakout move. Low point here, same thing. So when you're in a secular bull market and volatility gets to a really low point, you're coming up on a potential breakout. Of course, if the price action is setting up for a breakout. Now here's the present. Here we can see the cup and handle right here. This is GVZ. So this is also a volatility indicator. This is the VIX for gold. So we all know about the VIX that gets referred to so often for the stock market. GVZ. And so when volatility shoots up really high, like we see here, that was a peak. Here, volatility shot up really high because that was COVID. So this is actually a bottom, or just came after a bottom. We can see here, this was the Russian invasion, market peak there. And so here's the Bollinger Bandwidth. So we can see here, there's some decline of volatility here, market moved high. More decline of volatility here, market moved higher. More decline of volatility here, but the market moved down. False breakout, breakdown. This was similar here. Low volatility here. And we had a breakdown in 2018. Now, let me go back for a second. This is where we are here and now. Look at how stretched we are right here. So what does that tell you? This needs to come down like that. And it will, because this is going to go like this. And this will peak out like this. And then this will come down. But that hasn't happened yet. Look at where we are. This tells us that we need to spend more time consolidating. This is good, though. This is the gold VIX. This is good. So we're down here. Now, with respect to the consolidation, it's important to track how gold is performing in real terms. How is gold performing against the other markets? I called this gold versus. I didn't forget to type something here. I just call it gold versus because it's gold versus everything else. Gold versus foreign currencies here, gold against the equal weight stock market, gold against the stock market, gold against commodities. And so here's gold. We can clearly see, if we step back, this is a bullish consolidation. Even if it comes down here to, what did I say, 3150, 3175, it does that. This is still a bullish consolidation. This is looking really good. Like I said, it just needs more time because this is a 200-day. This needs to come up like this. Gold needs to move like this before it breaks out like that. And we can see the same thing in these indicators. Here's gold against foreign currencies. This is going sideways. The 200-day moving average is a lot closer. But what I really like here is that this could be a bottom as far as gold against the equal weight stock market and gold against the stock market. This could be a bottom here. This was a previous resistance right here. Gold broke out of a 4.5-year long base against the stock market. Is this a successful retest? So you have this strong support here, 200-day moving average. This gets me really excited. So that's a really good sign for gold. Even if gold were to go like that and test this, as long as this holds this, gold is still in really good shape. Here's gold against commodities. Again, 200-day moving average, not quite there yet, but when you look at this chart, this looks pretty good. I mean, all of these look good. Gold just needs more time. It needs more time to consolidate. And last chart here. So gold's three biggest breakouts in its history are clearly 1972, 2005, and then, of course, 2024, that cup and handle breakout, which I love mentioning. So I made an analog chart here looking at the current breakout and putting these historical breakouts on the same scale. And so this is the average here, and this is the current one. Now, these are much thinner lines because I want you to focus on this right here, which is 1972, which is blue, and then the red here, which is 2005. So this is where we are right now. This is weekly data, by the way. Look at where the 2005 breakout peaked and the 1972 peaked. So they peaked here and here, which is really close to where we are here and now. So what happened? This is the correction after the 72 peak, right down here. So this is 4.5 months. And this was a bigger correction. You had the first leg down, a little bit of a rally, then it petered out down here. So this was 5 months. So 5 months here, 4 months here. And then look what happened. And then look what happened after 2005. It took a longer time, but, this still, you're above 4,000 10 months from now, even in this, which I don't think that's the best comparison right now. That's why I put in the average here. I think the average is a better comparison. But I like using the 2005, 2006 market because we can see here, this was a 5-month correction. This was 4.5 months. So that gives us a sense of what we can expect here and now. And again, this is weekly data. The correction really started here. If you look at the daily chart, the candle charts. So we have more to go, more time to go, but I suspect something like this could happen. So that's where we are for gold. I just wanted to delve into the current setup and what's likely to happen over the next few months. And if we look at history, it clearly tells us that gold needs more time to correct. It doesn't necessarily mean in price, but needs more time for the moving averages to catch up, and it needs more time for volatility indicators like Bollinger Bandwidth to come down. And at that point, gold will be in a better equilibrium because there's too much selling around these levels. There's too much supply because there's a lot of people sitting on big profits, and that's perfectly fine. They're taking profits. Strength is getting sold right now, but weakness is getting bought, and that'll go back and forth for another month or two. Then gold will be in position for the next leg higher. So let me know what you think. I know this was a different type of video, kind of specific and technical. Would love to hear your comments. Thank you so much for tuning in, and hope you have a great week ahead. And a couple days, we're going to have our monthly interview with Vince Lanci for you. Thank you.